It's the Real Estate Podcast, brought to you by ANZ Home Loans for financial well-beings.
It's your weekend real estate breakfast property podcast around Australia. And did we just carve off 31 days in January? I think we did, because it's Sunday, February the 1st. Do that 11 more times and 2027 is going to be here. How silly are you finding the real estate market right now at the start of your year? It is crazy out there. And coming up, we have the last of our time tunnel for this year with our summer series. And a big thank you to all of our contributors for our 2025 year of breaking down the real estate stories as they happened with us. There is a lot to report on, and we are going to be back from tomorrow. In fact, we're talking tiny living home space tomorrow. Brad is back. He's been on once before, and he is going to tell us about the ever-growing shipping container conversions, and he is doing these and a lot of them, so he knows all about it. And it might surprise you, some of the information. That is first thing tomorrow morning for breakfast. Catch you then.
You're listening to the Summer Series on the Real Estate Podcast.
I think since 1st of October, since that scheme came in, there's been a real urgency around first home buyers to get into that space. The average price point for a unit in Sterling is around that $750 mark. So that's a good sweet spot for those buyers. But I'm finding that, I believe, will increase quickly. Well, the limited opportunity in that price point, it'll drive up to that $850 mark pretty quickly, I reckon.
I do want to find out a little bit about the infrastructure on what is going on in Sterling, because there's things being built.
There's been a lot of money spent in the last few years in Sterling, which has helped that growth. I think that's given confidence to people looking to get into the area. You've got the new Rosalie Village shopping centre, which has got your Woolies and your medical facilities and coffee shops. And that's just improved the livability and the walkability of the area out of sight. The local high school catchment, which is Balcatta Senior High School, had $60 million invested in it a few years ago, which has really improved that facility. And then in addition to that, they're improving the freeway exits to help the flow of traffic through Cedric Street. So there's been a lot of money spent on the area to improve livability and accessibility, which has really made it quite popular.
Yeah, so for October, home values rose again, but it wasn't just any increase in home values. We've seen values go up by 1.1%. So that's the fastest monthly gain since June 2023. It coincides with continued increases in income, very low levels of housing supply, with listings sitting about 18% below their historic 5-year average for this time of year. And of course, the expansion of the home deposit guarantee, where the federal government have removed income caps for the scheme and places for the scheme, as well as significantly increasing the property price caps that qualify for it. So no doubt that's added to the flurry of buyer demand that we've seen in the month of October.
Yeah, and the home value index for the month of October, the pickup in the pace, I understand the fastest monthly gain since June of 2023. Tell us about that.
Yeah, so usually you would expect to see a little bit of a seasonal pickup in home values through spring, but this comes off the back of maybe a more subdued upswing so far. Nationally, home values were rising by an average 0.6% a month, so to see them jump 1.1% in the month of October reflects that not only are we in a rising market, but that rising market is picking up steam. It's really heating up.
Let's have a look at the monthly leader for October. This is for the latest home value index, because I understand you've got Perth in the mix and also Brisbane really revving up.
Yeah, this is remarkable. So these are markets that have already increased over 80% over the past 5 years, and now they're continuing to lead the pace of gains. So we've got Perth home values up 1.9% in the month, and Brisbane is sitting up 1.8%. Now, these markets have been supported by kind of virtuous cycles, as you might call them in economics. So a lot of migration to Western Australia and Queensland, which means you have increases in economic demand, which means you have more jobs growth, which means you attract more people. Add to that things like a strong commodities cycle, which is supporting the mining sector in WA. And in Queensland, of course, a boom in infrastructure ahead of the Olympic Games for Brisbane. And this is all equating to outstanding increases in property prices. Great for homeowners, but of course not so good if you're trying to break into the market with the deposit hurdle getting away from you.
And we should look at what is happening regionally because there has been a lift.
Regional Australia has been really interesting. It's kind of lagged capital city growth performance through the start of the year. But what we're seeing now is that the market has jumped up a full 1 percentage point. And again, that's off the back of average monthly increases of about 0.5% through the year to date. So this is a significant pickup in the pace of growth for regional Australia specifically. And again, I think coming back to the expansion of the 5% deposit scheme, a lot of the price caps that applied to capital cities also applied to major regional centres, areas like Newcastle, Illawarra, Geelong. While the price caps of the scheme might cover about half the house markets in Greater Sydney, it would cover nearly 100% of the house markets in those big regional centres of Illawarra and Newcastle. And I think that may have pushed some demand to the regional centres. And again, it's a reflection of the challenge that we have with regional Australia being perceived as an affordable alternative to the cities. This just goes to show that if you're attracting a lot of demand to the regions, it makes it harder for locals to break into the market.
Right, let's have a look at Melbourne. As I mentioned, it has officially emerged from one of the most extended buyers markets in history after nearly 2 years of flat conditions following the 2022 downturn. Yes, the city has now recorded back-to-back months. You'd be pretty happy about that, wouldn't you?
Well, on the buyer's side, it's made it a little bit tougher. Now, it is good to see the markets bouncing back. Sydney has always been expensive, but we've seen Brisbane, Perth and Adelaide all boom, and it's good to see Melbourne back on track after, as you said, a very extended period, which hasn't been in its history. I don't think it's gone backwards 2 years in a row ever in history. So it's been a very interesting time here in Melbourne.
And the extended stagnation, we should talk about that because that was made worse by the higher land taxes on secondary properties. That policy saw many investors rush to sell lower grade homes, creating this oversupply and holding prices down far longer than usual. That is probably something that you were stuck right in the middle of.
Yeah, absolutely, Craig. It was an interesting time. It was you had to sort of sift through. We had really low stock levels, but the stock levels were being bolstered by these what we would call B and C grade properties that were coming onto the market because investors could no longer afford to pay the land tax that they needed to do on those. 80% of investors in Melbourne are mums and dads. It just got too difficult. So a lot of these properties weren't maintained very well during their tenancy, and when they came to market they didn't have money spent on it either, so we had to sort of work through that and work out which ones were the good ones, which ones weren't. And so our buying clients really relied on us in that time to not only know that they were getting a good priced property, but getting one that wasn't going to be a lemon later down the track.
Yeah, that oversupply and holding prices down longer than usual, really interesting when you have a contrasting look at past cycles like the 2018 or even the GFC, where those recoveries were much quicker. But the good news is the recovery is definitely back. I want to talk about the Northwest Corridor. We've been talking about that on the Real Estate Breakfast in the last couple of months. That has helped Victoria's recovery without a doubt. And I'll get you to explain some of the regions in particular that are standouts for you.
we've seen a lot of growth out past Tullamarine, Sunbury, Macedon, and then sort of into Mildura as well. So what we are seeing is that people are seeing regional Melbourne as a location to invest at the moment. We don't do a lot of purchasing in those areas, but we speak to a lot of buyer advocates that do. We're certainly seeing a lot of people sort of jumping on board that, because the big build here in Victoria, although it's over time and over budget, it will certainly improve transportation to these areas as well. So people are sort of getting ahead of the curve there as well. So we're seeing a lot of growth regionally, but we're also seeing a lot of growth locally as well.
Something we've also been talking about, Matt, quite a bit over the last couple of months is this underquoting. And I'll get you to weigh in here from a buyer's agent's point of view, just how frustrating this is for you and the buyers you represent.
Yeah, certainly the buyers that we're representing hugely frustrated, because when you've got a rising market, the agents are very slow to update their price ranges, etc. When you've got a falling market like we have had when we did have in Melbourne in 2022, they were very quick to update pricing, very quick to be talking to owners and reducing prices. But what we're seeing is buyers are coming to us after missing 2 or 3 or 4 auctions that they thought they had a chance to buy. Realistic terms, when we go through it and we explain to them, listen, if you had been with us at this time, we would have told you that this property was going to sell for 1.3 when it was quoted, 9 to $1 million, then you would have saved yourself a lot of time and grief, potentially money as well, because people are spending money on building and pest inspections, contract reviews. They're never in with a shot and see it sell for $200,000-$300,000 over. So that's where we do come in to, I suppose, straighten them up a little bit and guide them to more properties that they actually can afford.
Grab your weekly dose of inspiration to help build a real estate portfolio. We talk to the best in the business every day. Learn from the professionals and know your property with us.
But these banks, as per you guys reporting, are starting to intensify their fighting for customers.
Yeah, yes, indeed. So you normally get 2 or 3 of these kind of cashback offers in the market at any given time historically, but the volume of them in the market seems to be increasing dramatically recently. In fact, at last counted finder, we found 11 different home loans with cashback offers and 5 different home loans with frequent flyer point offers, including the one that's been making the headlines recently from CBA. Their online loan gives you 300,000 Qantas points on sign-up, which is interesting because that's higher than the actual Qantas home loan, which only gives you 200,000. So it definitely seems that banks are increasingly offering extra kind of bells and whistles on top of just a low interest rate to try and attract customers in this increasingly competitive market.
Yes, so let's just run through some of these banks. I see that Bank Vic leads with up to that $5,000 for refinances at 5.35%. And you've got some other banks in on the action as well that are showing up.
We do indeed. So the range of banks that these are on offer from go across the market, from AMP to ME Bank, Greater Bank, IMB Bank, Bank Vic, as you mentioned, Newcastle, Regional Bank Australia, a couple of credit unions as well, Bank of Queensland. You can find the full list on Finder. The cashback offers range from about $2,000 to about $5,000. And the home loan interest rates kind of vary across that range too. In terms of frequent flyer points, we're seeing offers from 100,000 to 300,000. Now, interesting, the CBA 300,000 Qantas points loan, just trying to compare that to the cashback. The value of your Qantas points depends on how you use them. But if you can use those points for classic flights, which are difficult to book, but if you can do it, those 300,000 points are going to be worth about $6,000. So that will actually give you a better return than any of the cashback offers. And if you can use them for business class flights or upgrades, you can get even more. So if you fly a lot, that could be the one to look at.
So there's some great news there for refinancing, but the experts are saying these incentives may not last long. So it's kind of a cheery at the moment, but they may very well be withdrawn, early next year? Who knows?
Yeah, they kind of come onto the market and disappear on the market with no notice. So if you see one that's really attractive to you, it's probably worth putting some effort into getting it quickly. The thing to note, though, is I wouldn't take any of these on board unless you're paying no higher an interest rate than you're currently paying, because over the long course of the loan, that's the most important figure. But I have heard a lot of Finder colleagues, for example, have switched to home loan to the same interest rate just to get the cashback offer. And I'm talking to colleagues who are doing that every couple of years. So, if you want a couple of grand into your bank account every year or so, this could be one potential way to do it.
I remember last year we were talking about this whole sort of refinancing because so many people, and you'd know this at Finder, they set and forget. But I think probably post-COVID, well, it took them a long time actually post-COVID to then start looking around and going, well, hang on, there are better terms and conditions out there. I need to change banks. And that whole education piece, it did take some time to sort of filter through.
It is, yeah. In the industry, we call that the lazy tax. So people tend to sign up, especially with something like a mortgage, which is the biggest expense of your whole life, and just keep going with the same bank and forget. And they tend to prize loyalty with an individual bank. But in this market, loyalty generally doesn't pay, which is why it's important at least every couple of years to look at the rate you're paying, use a comparison service to see what the lowest rates in the market are, and see if you could be getting a better deal. The last research we did looking at the average home loan rate in the market versus the lowest rate found about a 40 basis point difference. That's nearly 2 cash rate cuts equivalent that you could be giving yourself if you do find a better price loan than the one you're on.
Yeah, and if you're one of these people that think, yeah, I want to remain loyal to my bank. My bank has been fantastic to me over the last 10, 20 years, whatever the case may be. Get out of that way of thinking, because your bank is not loyal to you. You've got to look after number one. And again, that loyalty factor, it's a bit of a mystifying thing how people sort of get sucked down the rabbit hole of being loyal to their bank.
Yeah, I think it's an old-fashioned thing as well. So we tend to find with Finder consumers, those above 40 tend to be, and I'd be in that group, tend to be more loyal and stick with the same bank. And those under 40 tend to be far more likely to switch and therefore far more likely to get the lowest rate. And this doesn't just apply to home loans, credit cards, personal loans, even broadband packages, phone deals, all that kind of stuff. Generally, the early bird gets the worm.
We connect you to the best real estate information across Australia. The Real Estate Podcast.